Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF Conference. I'm here with Todd Rosenbluth, director of ETF and Mutual Fund Research for S&P Capital IQ. Great seeing you, Todd.
Good to be with you, Tom. Thanks.
This is always an exciting conference.
Yeah.
There's a lot going on, having it at the first of the year. So we got a couple minutes to give advisors a little bit of maybe guidance based on what's going on in the markets today and all the opportunities in ETFs. What are some of the top things you think advisors should think about?
Yeah, I mean, well, we've already started 2016 on a more volatile period than we saw in 2015. We've had the Fed raise interest rates once in late last year. There's likely to continue to raise interest rates, and that's going to impact people's portfolios, both on the stock side as well as the bond side. We've got some more choppiness going on in emerging markets and concerns of what's going on in Europe. So really understanding what's inside your portfolio, understanding the risks you're taking on, and then trying to offset that using ETFs in a low-cost way. I think that's really the goals in 2016.
Are ETFs getting more confusing though? I mean, there's so many types of, with smart beta, evolution, and all these esoteric models or strategies with ETFs, and all these new issuers that are coming in with their own models. Is it gotten too confusing for advisors?
I mean, you now have more tools at your disposal than you ever did before if you're an advisor, and that's great, but understanding what those tools are, understanding the differences between them. There's a lot of products that sound the same but are not the same. We touched on currency hedging. There's products from iShares, from WisdomTree, from Deutsche that all sound like they're giving European exposure, but what is Europe as far as they're concerned? Does it include Switzerland? Does it include the UK or not? There's really things that you need to look inside the portfolio, see what's going on there, and determine if that's right for you and your clients. And that's something that's hard to do on your own without help from firms like us at S&P Capital IQ or others.
So the strategy, for example, with currency hedge is valid. We may continue to see divergence in strategies, but look under the hood, make sure you understand what you're buying.
Exactly, because they're not going to perform the same way. Things that are not the same are not going to perform the same way, and 200, 300, 400 basis points differences between them can really make your clients either be happy or unhappy at the end of the year based on what ETF you chose, and you really need to know what's going on with that drivers.
Okay. You touched on emerging markets. Not all emerging markets are created equal. It used to be buy the EEM, VWO, that's it.
Right.
Is it different today?
It is. So Vanguard is now tracking a different index from FTSE, and South Korea is not considered an emerging market in that space, but China A-shares is part of that portfolio. So you have different exposures to China, to South Korea, to other markets as well, depending upon if you've chosen VWO or you've chosen EEM or any of the other products that's out there. So you really need to understand what's behind the index provider, how they classify companies, what their plans are going forward, because again, there's going to be performance differences between those products.
And finally, rising rates.
Yeah.
We've heard a lot about rising rates. Finally, we're here. What are some strategies that advisors might consider that could help hedge during this rising rate environment?
Yeah, I mean, so there's a couple of things. There's some sectors that tend to do better during rising interest rates, like consumer discretionary, for example, and sectors that tend to do worse, such as utilities in that environment. So just understanding your exposure to one sector versus another. You can also do Xing out the interest rate sensitivity. PowerShares has a portfolio that looks at low volatility, X interest rate sensitive, or you could even add a hedge to that. We talked about currency hedging. There's interest rate hedge products that are out there from the bond perspective, so you don't take on that interest rate sensitivity, but you get the credit quality or you get the high yield exposure that you'd want from a bond perspective. And we think those are going to be popular in 2016.
Excellent. Todd, as always, really love your work. Thanks for stopping by.
Thanks, Tom. Appreciate it.
Thank you.